Hi, this is Dan Collins, editor-in-chief of Modern Trader magazine, coming to you live from the floor of CME Group for Traders Exclusive. Today is September 8th, a little bit less than 2 weeks before the next Fed meeting, and we saw an interesting piece of information come out of Goldman Sachs 2 days ago where they expected the Fed to tighten at the September meeting. It's a very interesting meeting in the fact that if you look at the Fed funds futures, there's only about a 20% chance of them tightening based on the Fed fund futures. But if you go all the way out into January of 2017, there still isn't even a 100% chance that there'll be any rate increase for the rest of the year. That dichotomy is pretty odd, and it goes to what we have commented in the past about the June meeting, that was kind of the point that they were supposed to act, and there was an assumption that tightening had been taken off the table. It's an assumption. The Janet Yellen never said this. In fact, Fed officials have been hinting towards a tightening. They've been in the press going back and forth, which I think has brought a lot of confusion to the market, because you wouldn't be in this cycle where we began tightening last December. While they made sure they didn't want to forecast anything like the last tightening cycle where they tightened 25 basis points every meeting. The idea of, are we still in a tightening cycle or are we in a freeze, is out there, because people don't think anything's going to happen this year. There's kind of an assumption in the media when one of the Fed governors comes out and says something slightly hawkish. It's like, will they reverse policy? Well, there was never any official reversal away from the tightening posture. They were always waiting on data. They were always going to be patient, they said. But what's the length of patience? Now, there's a couple arguments against them moving in September. One is there's stimulus coming out of Europe, and that would really be harmful. The recent unemployment number wasn't bad. It wasn't great. Really, it shouldn't be enough to affect that decision one way or another. And of course, we have a presidential election that's really heating up. I think while it's fair to say that they typically would not want to affect it, and it would be common for them not to act going into it, this is a different situation. Rates were frozen at zero for 7 years, and they tightened once. And they've been trying to portray the economy as growing and as a solid recovery. You can't do that and have one increase in 8 years and then wait a whole year. So I would think that the Fed would like to portray their belief that the economy is improving, and to wait a whole year after beginning a tightening cycle doesn't square with the facts. So I think there may be a bias towards that going into this election year. September tightening is definitely not a definite, but it's certainly on the table. If you listen to Vice Chair Fisher, he's been pushing towards that way. So don't be in a position that in your positions in the market that's assuming nothing's going to happen. I think there's been so much debate about it that I don't think it'll have as great of an impact on the market as most people think. I think there's an assumption by most people that there will be one tightening before the end of the year, whether this time or December. They may want to do it sooner because you don't know what's going to happen in the election, and then they're caught doing nothing for a whole year. So I wouldn't call it 100%, but I think it's a lot closer to 50-50 and a September rate cut. So, protect your positions accordingly. This has been Dan Collins, editor-in-chief of Modern Trader magazine. See you next time.